Unlocking the power of financial management for business success. Financial management is an essential part of any business. It is the process of managing and optimizing financial resources to achieve the organization's goals. It involves planning, organizing, controlling, and monitoring financial activities such as budgeting, cash flow, capital, and risk management. With effective financial management, businesses can achieve success in their operations and create strong financial returns. Introduction to financial management. Financial management is an essential component of any business. Through effective financial management, businesses can achieve their operational objectives and create strong financial returns. Financial planning involves setting goals for the organization's finance operations and developing strategies to meet those goals. This includes creating a budget to track income and expenses, forecasting future cash flows, assessing risk levels, and managing liquidity. Cash flow management is another important aspect of finance management. It focuses on when funds are available to meet obligations, ensuring sufficient liquidity is available to cover short-term needs such as paying suppliers or employees. Capital management involves understanding and managing the capital structure of the business in order to optimize returns for investors. Risk management is also an important part of finance management. It involves identifying, assessing, and managing financial risks in order to minimize their potential impact on a business. Financial risk management strategies can involve diversifying investments, hedging against currency fluctuations, or buying insurance against certain risks. Benefits of financial management. Financial management is essential for businesses to achieve their desired goals and create strong financial returns. It helps businesses manage their finances efficiently and effectively, enabling them to make better decisions and manage their resources more effectively. Financial management allows businesses to identify and manage financial risks, enabling them to avoid costly mistakes. Financial management also helps businesses identify areas of potential growth and investment opportunities, enabling them to make the most of their resources. The benefits of effective financial management are numerous and can be seen in a business's long-term and short-term success. The primary benefit is that it helps businesses achieve their desired goals by optimizing their use of resources, including capital and finance. Financial management also gives businesses better control over their finances and greater insight into their financial performance. This allows them to make more informed decisions about allocating funds, investing in new opportunities, or managing risks appropriately. It also enables businesses to identify potential growth areas, helping them generate higher returns on investments and increase profitability. Financial management strategies. Financial management strategies are the techniques and methods used to manage financial resources. These strategies include budgeting, cash flow, capital, and risk management. Budgeting is the process of setting financial goals and creating a plan to reach those goals. It involves estimating the amount of money needed to achieve the goals and creating a plan to track and manage expenses. Cash flow management is the process of managing the inflow and outflow of cash. It involves managing cash inflows and outflows, such as sales, expenses, taxes, and investments. Capital management is the process of managing the capital of the organization. It involves allocating and managing the capital of the organization in order to maximize the returns and minimize the risks. Risk management is the process of identifying and managing potential risks associated with financial activities. It involves identifying potential risks, assessing their impact, and developing strategies to manage them. Financial management tools. Financial management tools are the systems and software used to manage financial resources. Budgeting software is used to create, manage, and track budgets. It can be used to create detailed budgets and track expenses, enabling businesses to make better financial decisions. Financial planning software is used to create financial plans and strategies. It can be used to create detailed financial plans and track performance, enabling businesses to maximize their resources. Cash flow management software is used to manage cash inflows and outflows. It can be used to monitor cash flows, identify potential risks, and develop strategies to manage them. Risk management software is used to identify and manage potential risks. It can be used to analyze financial data, identify potential risks, and develop strategies to manage them. Cash management and cash flow. Cash flow management involves forecasting cash inflows and outflows, identifying and managing potential risks, and developing strategies to optimize the use of cash. It is important for businesses to monitor their cash flows and ensure that the cash inflows are sufficient to cover the cash outflows. Cash management and cash flow are critical for businesses to be able to meet their operational needs, finance growth, and manage financial risks. Proper cash management helps businesses maximize their use of capital by ensuring that funds are available when needed and minimizing the amount of idle cash in the business. Financial planning and budgeting. Financial planning is the process of creating a plan to achieve the organization's financial goals. It involves creating a detailed plan that outlines the goals of the organization, how they will be achieved, and how the resources will be allocated. Budgeting is the process of setting financial goals and creating a plan to reach those goals. It involves estimating the amount of money needed to achieve the goals and creating a plan to track and manage expenses. Budgeting helps businesses manage their resources and meet their financial goals. Risk management. Risk management is the process of identifying and managing potential risks associated with financial activities. It involves identifying potential risks, assessing their impact, and developing strategies to manage them. Risk management involves analyzing the financial data and understanding the potential risks associated with different activities. Risk management also involves understanding the different types of risks associated with different activities, such as market risk, liquidity risk, and credit risk. Managing risk helps businesses reduce potential losses and maximize potential returns. Financial reporting. Financial reporting is the process of preparing and presenting financial information. It involves preparing financial statements, such as income statements, balance sheets, and cash flow statements, and presenting them to stakeholders. Financial reporting is an essential part of financial management. It helps businesses understand their financial position and make better decisions. Financial reporting is important in financial management as it provides stakeholders with an accurate and up-to-date view of a business's financial position. Financial statements provide stakeholders with key information about the performance, risks, and opportunities associated with a company. Accurate and timely financial reporting helps businesses identify potential problems early on and make informed decisions. It also enables them to manage their finances efficiently, which can help boost profitability and create long-term value for the organization.
Be sure to like and subscribe. And check out the links below.